Hello, my name is Brian Trudy with CMG Mortgage. More than just an account executive who can help with conventional and government business, I am a business development advisor who will provide several methods to increase loan production that are not currently incorporated in your business plan. This includes expanding your business with referral partners, high net worth individuals, and past clients. What's better? The information is free, and you may contact me anytime to guide you every step of the way. Before we jump into these marketing strategies, let's take a quick look at the mortgage product most borrowers request, the 30-year fixed loan. Your client knows the rate and their monthly payment, but few understand the true cost of the loan over a 30-year period. For example, on a loan amount of $500,000 at an interest rate of 5.25%, the Truth in Lending statement reveals that the total payments at the end of 30 years will exceed $993,000. That's almost 100% interest cost, meaning the interest paid will be nearly equal to the original loan amount. The table shows the interest charge for each interest rate. The amortization schedule is what makes the 30-year fix so expensive. Keeping with our same example of a $500,000 loan at 5.25%, the monthly payment is $2,761.02. In the first month, $2,187 will be applied to interest and only $573 to principal. Let's fast forward to month 60 or 5 years into the loan, where the total interest paid to date exceeds $126,000. That's over 25% of the total interest that we paid on the loan, and the loan balance barely changed. Not until month 203, or almost 17 years into the loan, will the principal portion of the payment exceed what is applied to interest within the monthly payment. To summarize, a 30-year fixed mortgage front-loads interest, with a smaller portion allocated to principal until about 2/3 of the way through the loan. Let's take a quick look at how most of us have our finances set up. With a loan amount of $500,000 at 5.25% interest rate, the monthly payment is $2,761, of which $2,187.50 is interest in the first month. On the other side of the balance sheet, a person holds liquid assets in checking and savings accounts. For a person who holds $100,000 at the bank at 0.25%, the money is earning $20.83 per month. Not an efficient place to park your money, especially when you're borrowing at 5.25%, but what a great profit model for the bank, who can lend up to 10 times what they hold on deposits. If we look overseas, countries such as Great Britain offer a different banking model that simply offsets the mortgage balance by the amount held in checking and savings. With savings equal to $100,000, the mortgage balance would be reduced to $400,000 from $500,000. The homeowner is able to aggressively deleverage by using an offset mortgage without losing the ability to access the money. Since the balance is lower, the interest is also lower. How do the two methods compare? Great Britain's method of combining checking, savings, and the mortgage into one creates an interest savings of $416.67 per month. Instead of cash sitting idle at the bank, it is efficiently working to reduce the loan balance and therefore reduce interest. The U.S. homeowner also has the ability to offset their savings against the home loan to reduce interest with my all-in-one mortgage named the Homeownership Accelerator. Your savings and income lower your monthly balance. The lower balance saves you interest. The saved interest becomes extra principal. The cycle repeats itself each month, with your income compounding and accelerating the payoff. What we've done is quite simple. We have fused a checking account and a first equity line of credit into one instrument so that savings and cash flow work efficiently to reduce the loan balance and therefore reduce interest. The money you have offsetting your mortgage may be accessed anytime, so you still enjoy complete liquidity. On an amortized loan, the balance is constant for the month until a payment is made, at which time the balance decreases slightly with very little allocation to principal. On the all-in-one mortgage, your income dramatically reduces your balance the day it's deposited. Through the course of the month, money goes out for living expenses, and at the end of the statement period, interest is calculated based on the average daily balance. So, the longer the money sits in the account, the lower the interest. At the end of the month, the reduced interest and positive cash flow carry into the next month with the reduced mortgage balance. The effects compound monthly, accelerating the payoff of the loan and reducing interest. What affects daily balance? Money from direct deposit, bonus, and dividends may be applied to reduce the mortgage balance. With the advice of a tax preparer, you may even float rental and business income. The all-in-one account allows full access to money deposited the same way as with traditional checking accounts. Check, ATM, debit card, free online bill pay, and online transfer. What can the all-in-one mortgage do for your clients? Our calculator allows the input of income, assets, and spending habits to generate a summary page. The calculator exhibits the number of years the loan will pay off and the interest cost compared to your current loan or a new loan. On average, the years to pay off and the interest cost is cut in half or more. Now that you know how the program works, here are the top 10 reasons for you to sell the all-in-one mortgage. Number 1. Instead of selling just rate and payment, you'll be differentiating yourself as a mortgage professional who works to align the home loan with the borrower's financial goals. Number 2. Build relationships with financial advisors and CPAs who'd be interested in a financial tool that will help their clients increase liquidity, better manage cash flow, become debt-free sooner, and achieve true financial independence. Realtors will be interested in your access to a portfolio program with many niches, including the ability to close escrow within 15 days, even on a super jumbo loan amount. Number 3. If you refinance a borrower down to the low 4s on a 30-year, you may not normally have the ability to refinance them again. With this program, you may refinance the client and improve their situation by accelerating the payoff and dramatically reducing their interest cost. Number 4. Gain access to a portfolio program that allows loan amounts from $100,000 to $2.5 million and higher on exception. Has aggressive pricing currently near 3.5% with one rebate, so you can compete with the big banks. Additionally, the minimum payment is interest only for ultimate flexibility. Number 5. No cash out seasoning. Unlike conventional products that require 6-month seasoning, you may refinance a borrower right after they paid all cash on a property. Number 6. No title seasoning. Another way to attract realtors. Number 7. Small income producing properties. For example, a hobby vineyard. Number 8. Room additions without permits considered if completed in a workmanlike conduct. Number 9. Asset depletion considered on exception for retired borrowers or those clients holding $200,000 plus at Ameriprise Financial. And number 10. The program does not require a 2010 GFE and is not regulated under LO compensation. So what's the next step? I'm here to support you. Contact me with questions and scenarios or help presenting to clients and referral partners. Next, get certified. This will provide more training so you are comfortable explaining the program to clients. You may watch the video at your leisure, which will take less than an hour to complete. Then, go through your database and identify those borrowers who have positive cash flow and are strong savings. You can provide a huge service to the client and create a refi boom of your own. Next, identify financial advisors, CPAs, and realtors who will appreciate working with a mortgage planner that will provide benefit to their business. Lastly, contact individuals who recently purchased all cash on an owner-occupied property. They may be interested in a loan to replenish their cash. Don't let this opportunity pass you by. My name is Brian Trudy, Senior Account Executive and Business Development Advisor with CMG Mortgage. You may contact me anytime for scenarios, marketing ideas, or assistance presenting to clients or referral partners. Thank you for your time, and I look forward to working with you soon.